What's up, everybody? This is Sunko, the Korean bro, and today is 2023, July 27th. And let's see, okay? Hmm. One phenomenal growth stock to buy now before it soars 160%, according to Wall Street. Okay. Can a new CEO revitalize the Get brand? That's precisely what this person did for Matos Barbie. Getting into the wireless business or AT&T Verizon doomed. Meta, Microsoft, Amazon team up to take down Apple and Alphabet in a key segment. Here's what investors should know. Hmm. Okay. One phenomenal growth. Sea Limited. Shopee. Okay, Sea Limited. Southeast Asian Holding Companies Limited saw its share price tumble 83% in the last 2 years, dragged down by a combination of disappointing financial results and concerns about the broader economy. Uh, but most Wall Street analysts now believe the stock is oversold. Indeed, the median 12-month price target of $94.34 per share implies a not 54% upside from its current price. The highest 12-month price target of $159 per share implies 160% upside. The bullishness reflects limited presence in three large markets. Specifically, it has subsidiaries in e-commerce, digital finance services, and digital entertainment. All three markets are expected to grow relatively quickly in the coming years. Taking on e-commerce leadership position, Sea Limited e-commerce segment Shopee is the most popular online marketplace in Southeast Asia and Taiwan. It receives more visitors in the region's next five digital shopping destinations combined, and it was the third most downloaded shopping app worldwide in 2022. According to Apptopia, Shopee reinforces its leadership and strengthens the network effect inherent to its business by providing adjacent services for digital advertising, payment processing, fulfillment, and logistics, all of which make its marketplace a more convenient option for merchants. The company has also moved into Latin America to challenge Mercado Libre in Brazil, Mexico, Colombia, and Chile. Shopee is unlikely to dethrone Mercado Libre in the region, but it has outpaced the latter in mobile app downloads in the Brazilian market for the last 2 years. So the challenger is clearly having some success. Hmm. C-Money, the fintech platform that supports Shopee. C-Money was created to provide payment processing support to Shopee merchants, but it has since evolved into a larger digital financial services platform. Today, C-Money processes payments for third-party merchants in Southeast Asia, but both online and offline. In addition to handling most payments on the Shopee marketplace, C-Money also offers mobile wallet services and banking services to consumers, as well as ancillary products like credit and insurance. Looking ahead, digital payment volume in Southeast Asia is projected to increase by roughly 14% annually through 2027. According to Statista, the Sea Limited should be able to grow its fintech revenue more quickly than the industry average due to relationship with the Shopee marketplace. Garena, the video game developer behind Free Fire. Garena is a digital entertainment business that offers mobile and PC video games. Its platform connects gamers with licensed content like Call of Duty Mobile from Activision and Arena of Valor from Tencent, but the company is best known for its internally developed battle royal game Free Fire. Why is Limited stock is worth buying? C Limited reported mixed financial results for the first quarter. On the top line, total revenue rose just 5% year over year to $3 billion, despite stellar performances from Shopee and SeaMoney. Specifically, while e-commerce and fintech revenue increased 36% and 75% respectively, digital entertainment revenue from Garena plummeted 43% year over year as its paying user base declined. On the bottom line, C Limited had a fantastic quarter due to the implementation of cost-cutting initiatives, especially efforts real in sales and marketing expenses. It's reported a GAAP operating profit for all three subsidiaries for the second consecutive quarter, and cash from operations clocked in at $606 million. Absolute bargain compared to a 3-year average of 12.9. Investors should use that opportunity to buy a small position in this growth stock, but not with the expectation of triple-digit returns in the next year. Predicting price action over short periods of time is impossible, so investors that buy shares should be prepared to hold the stock for at least 3 to 5 years. Okay, let's see. What was this? Let's see about Roku. Okay, Roku. Finally, media streaming technology specialist Roku took a different path to this list. The company is currently unprofitable and cash consuming, so I can't pin on affordable profit based valuation ratio on it. However, I can certainly point out Roku's price sales ratio of just 3.2 times trailing revenue. Hmm. I should also note that the stock trades 85% below the all-time highs Roku reached 2 years ago. And before you reach for the smelling salts, let me assure you that Roku is running a perfectly healthy long-term business, happily making habit investments in product development and marketing efforts is running low. The digital ad market's weakness was a result of the inflation crisis in recent months. And Roku's top line should spring back to healthy growth as soon as advertisers are ready to spend some serious cash on marketing efforts again. Meanwhile, Roku has $1.6 billion of cash on hand, but no long term debt to worry about. The company can afford to muddle through a couple of slow years without slowing down its efforts to build the foundation of future growth. Roku stock looks like a no brainer buy, while its the skeptics have control over its stock price. Okay, let's go see about the one that I'm writing about, which is Shopify.com. Okay, Shopify.com. So one green flag and one red flag for e-commerce stocks. The global supply chain is back in action, waving a green flag for e-commerce retailers. Reduced market demand is a major red flag. Hmm. While with consumers keeping tight control of their household budgets, amid the current e-commerce market conditions, investors have an opportunity to snag premium stocks at a bargain. The global supply chain is back in action, waving a green flag for e-commerce retailers. Rebounding supply chains and hesitant shoppers. Where does the e-commerce sector stand? Let's decode the colorful signals. But others suggest the online shopping still sits in a market trough. Let's have a look at the green and red flags investors should consider before buying shares of e-commerce giant Amazon, Etsy, and Shopify. So let's go see Shopify, okay? Uh, E-commerce everywhere. A bull market could be here. Three reasons to buy Shopify stock. Sales trends were encouraging last quarter. Oh. Commerce everywhere. Like all of its peers, Shopify endured a growth hangover in the second half of 2022, but demand trends have stabilized and appear to be on the upswing. Gross merchandise volumes in quarter first was up 18% on a constant currency basis, compared to 16% for full year 2022. Overall revenue jumped 27% thanks to high demand for subscription service and payment processing. Gross merchandise volume in quarter first was up 18% on a constant currency basis compared to 16% for full year 2022. Overall revenue jumped 27% thanks to high demand for subscription services and payment processing. The business is winning in both the e-commerce and physical retailing channels too, implying there is a long runway for growth ahead. Shopify can build on its roughly 10% market share in the US, for example, while using its point of sale system to account for more in person transactions. Shopify's strong first quarter results demonstrate once again that we are the go to solution, powering businesses of all sizes on every surface where they sell. Shopify President Harley Finkelstein said in an early May press release. Rising margins. Wall Street is excited about Shopify's potential to boost profit margins over time. Much of the rebound will be driven by factors like the end to the pandemic related growth hangover and the aggressive cost that management has been rolling out over the last few quarters. The bulk of these expense reductions will come from the sale of its logistics business to Flexport, a move that should make Shopify a more efficient business overall. The logistics niche is extremely capital intensive compared to the company's core marketplace platform. After all, it was a complex distraction from the main business, too, so splitting it out will give management more flexibility to prioritize higher return investments. However, this profitability spike has yet to show up in the company's results, but investors should watch the trend in operating margin over the next year or so for signs the strategy shift is working. The price is right. As you might expect, you will have to pay a high premium to own an industry-leading stock like Shopify. The company is valued at nearly 15 times the sales today, up from less than 8 times sales earlier this year. That valuation is still far below the 60 times sales investors were paying for the stock at its peak. Sure, the company is currently unprofitable, and its growth rates have slowed as e-commerce demand trends have reverted to more normal patterns, but the business features many of the key ingredients that apply to most successful growth stocks. Shopify has a large market share in an industry that's set to expand for many more years, and several growth avenues target, including a bigger portfolio of merchant services. There's also a good chance that profitability will be much higher in 5 years than it is today. Considering these factors, this stock looks attractive even after its rally over the last several months. Hmm. Power and e-commerce. Okay. For any e-commerce company whose name isn't Amazon, getting online can be a challenge. Shopify offers tools and packages to make it a cinch. With turnkey websites and full payment options, it's no wonder it counts millions of clients and keeps growing. Although it's known as the go-to resource for small businesses, it has made a big push to attract mid-sized businesses as well. There's a lucrative segment that pays for larger, more expensive, and more profitable packages. What's most compelling to me about Shopify Store is the range of products and services that can fit any customer's needs. That's how it has managed to capture so many clients, whether it's for full work up or only for some services. For example, it's a new commerce confidence product lets customers choose and buy specific Shopify services. They can be easily integrated into their website or physical store operations. Shopify has had a few slip ups as it overbuilt its infrastructure early in the pandemic, but it has continued to post robust revenue growth. It's now in the process of phasing out the overbuilded and is making progress in achieving stronger results. Its 2023 first quarter revenue increased 25% over last year. That's promising considering how customers have been scaling back digital shopping and spending more on real life experiences. Although operating losses widened from $98 million last year to $193 million this year in the first quarter, investors shared the company's decision to sell its logistics network. That's a great step toward getting back into better financial shape. Shopify stock is up 89% this year, and shares trade at 14 times trailing 12-month sales. That's a reach valuation, but Shopify has a huge opportunity ahead, and investors should grab the stock in the market pullback. If you're not familiar with it, Shopify is the antithesis of Amazon. Whereas Amazon requires all its sellers to use its single platform to list their goods and compete with every other seller, Shopify helps merchants and vendors set up their own standalone e-commerce platforms. It allows merchants to collect more vital information about their customers that it doesn't have to share with a competing third party. and businesses of all sizes are increasingly embracing the idea. Although the company itself no longer publishes a specific figure, plausible estimates indicate there are between 4 million and 6 million active Shopify stores. Meanwhile, we do know that Shopify's customers sold $49.6 billion worth of goods and services during the 3 month stretch ending in March, generating $1.5 billion worth of revenue for Shopify itself. Those numbers were up 15% and 25% respectively, extending a growth pace that's been in place for a few years now. Don't look for that growth to slow down anytime soon either. While online stores aren't uncommon these days, Zapier reports that only 36% of all small personal businesses in the United States offer e-commerce option to customers. That leaves on the order of around 20 million small businesses that could still run an online sales platform using Shopify's tools. According to Small Business Administration count of nearly 32 point, that's a lot of opportunity. Hmm. Okay, this is it with Shopify.com. Hmm. The reason why I'm reading an article about Shopify is because this is the topic that I'm writing about, and I still need to work on it. It's not done yet, and I still have a lot of sources left. But then at the same time, I feel like I gotta keep reading, otherwise I'll be you know I'll be getting lost. But okay, anyway, the one that I'm going to look at after is Unity software. Let's see. Hmm. Unity software. Okay. Hmm. One AI stacked by Hanover Fit before it soared 65%. Okay, let's see. Unity Software recently announced a generative AI solutions and Wall Street reacted positively. The company is enjoying impressive growth, which may now accelerate after its latest moves. Unity stock could deliver stronger gains than most analysts are expecting from it right now. Could soar higher, following its moves in the fast-growing generative AI market. Mm. After the company announced a clutch of artificial intelligence solutions, and some on Wall Street believe the stock still has a lot of room to run. Based on the estimate of 20 analysts covering Unity, the stock has a median price target of $43, which is where it is trading now. Following its latest surge, however, the straight high price target of $66 suggests that Unity stock could surge another 52%. It wouldn't be surprising to see Unity exceed that price target considering the impressive pace at which it is growing and the catalyst that it is sitting on, especially in AI. Let's take a closer look. AI could give Unity's growth a nice boost. The craze around AI has grown remarkably over the past few months thanks to the popularity of generative AI. Applications such as ChatGPT, Stable Diffusion, and the new AI-powered Microsoft Bing search engine. The technology is currently in its early phases of growth and is expected to gain critical mass going forward. More specifically, the global generative AI market is expected to clock annual growth of 32% over the next decade, generating $126 billion in revenue in 2031. The technology is expected to impact multiple industries, including video gaming. Hmm. According to research from Market.us, generative AI in gaming is set to generate $7.1 billion in revenue in 2032, compared to just $922 million last year, growing at an annual pace of 23% over the next decade. This presents a solid opportunity for the company to accelerate its growth, as its Unity game development engine controls 30% of the market. Unity is known for providing developers with a platform with which they can create real-time content in 2D and 3D that can be consumed on smartphones, tablets, computers, gaming consoles, and augmented reality and virtual reality devices. The company is now giving developers the power of AI to create real-time 3D content with its Unity Santis and Unity Muse platforms. Unity CEO John Rossetto believes that these tools will help creators and developers become 10 times more productive and help them bring their creations to life with interactive intelligence in a way never before possible. Rostillo also adds that he expects AI to revolutionize gaming, which explains why Unity is busy adding AI tools to its platform. Um, what's more, the company has also launched an AI marketplace that features creative solutions to accelerate AI-driven game development and gameplay enhancements. The marketplace has been launched with 10 AI-enabled solutions, which can be accessed by developers to speed up the process of game development. Unity stock surge indicates that the market is reacting positively to these launches, and it is not surprising to see why that's the case considering the substantial revenue opportunity on offer in this niche. Hmm. Solid growth could lead to a healthy stock upside. While AI could indeed turn out to be a nice catalyst for Unity's growth, the company also has terrific growth drivers that could help the stock surge higher. For instance, Apple is tapping Unity's platform to make apps for its recently revealed Vision Pro headset, which will hit the market next year. Hmm. Additionally, Unity's content development platform is finding traction in other lucrative areas such as digital twins, a market that's expected to grow 36% annually through 2030. A digital twin is a virtual representation of a physical object that is used for running simulations to gain insight into how the object would perform in the real world under different conditions. This technology is being adopted in multiple industries such as energy manufacturing, automotive, and engineering, among others. Unity is tapping these fast-growing areas with its Unity Industrial platform, which gives enterprises customers the tools to build digital twins. Now, Unity software has multiple growth drivers that should help it sustain high levels of growth in the future. Not surprisingly, the company's earnings are set to grow rapidly over the next couple of years. Okay, Palantir Technology, not Palantir, but Palantir Interactive, Palantir. Okay, let's go look at Cloudflare. Okay, Cloudflare. Struggling to justify their high values as their revenue growth cools off. Investors should stick with the more profitable player with the wider moat. Cloudflare's cloud-based content delivery network accelerates the delivery of photos, videos, and other digital content for websites. It accomplishes that by storing cached copies of the digital media on ad servers that are located closer to website visitors than the original servers. It also blocks bot-based attacks with its cybersecurity services. Confluent's cloud-based platform analyzes streaming data as it flows between the organization's applications. The data in motion is processed by Apache Kafka, an open source software platform that Confluent's founders initially developed as a data crunching tool at LinkedIn prior to its acquisition by Microsoft, which companies growing faster. Both companies are well poised to profit from long-term digital trends. The market's demand for Cloudflare CDN services will continue heating up as companies launch more media-intensive websites to capitalize on higher internet speeds. While the growing risk of bot-based attacks should convince the client to use more of its cybersecurity service, Cloudflare believes its bot blocking tools will eventually turn it into a water filtration system for the internet. Cloudflare revenue rose 52% in 2021 and 49% to $975 million in 2022. But for 2020, expect revenue to only grow 31 to 32% as the macro headwinds force more companies to rein in their software spending. Analysts expect its revenue to increase 31% to $1.28 billion as its adjusted EPS jumps 162%. On a generally accepted accounting principle basis, analysts expect it to not narrow its net loss from $193 million to $166 million. More companies will also use Confluent services to analyze how their applications interact with each other in real time to make faster decisions. But neither stock is a bargain yet. Based on their enterprise values, the Cloudflare trades at 17 times the year sales, while Confluent has a roughly slightly lower ratio of 13. It's more profitable, and the growth potential of its CDN and bot blocking service is easier to grasp than Confluent's goal of reading data in real time as it flows between applications. Okay. So he would say that Cloudflare is better than Confluent because of three reasons. One that he says first is its moat is wider. It isn't built on open source software and it's more profitable. And third, it's CDN. The growth of potential of its CDN and bot blocking services easier to grasp than Confluent's goal of reading data in real time. Cloudflare, okay. HubSpot. Let's go see about Cloudflare. Cloudflare provides a broad range of cloud computing services that accelerate and protect corporate infrastructure and applications while eliminating the need for costly on-premise hardware. Cloudflare has spent a good deal of time and money building a difficult to replicate network that shares a direct connection with every major internet service provider, cloud vendor, enterprise. So what? Its platform can deliver content to 95% of internet users within 50 milliseconds, making Cloudflare the fastest cloud provider on the planet. That unparalleled performance has led to strong demand. About 20% of the web runs on Cloudflare, and handling that traffic affords the company unique insight into performance issues and security threats across the internet. Those intangible assets help Cloudflare honor leadership position in several cloud verticals, including content delivery, network software, ads development platforms, zero trust network access, and web application firewalls. Cloudflare reported solid results in the first quarter. Its customer count increased 13%. The average customer spent 17% more. In turn, revenue rose 37% to $290 million. Non-GAAP operating margin improved to a record 6.7%. And the company generated positive free cash flow of $14 million, off from a loss of $36 million in the prior year. Looking ahead, Cloudflare says its addressable market will reach $204 billion by 2026, and a large portion of the figure comes from a ZTNA and a developer services. Two areas where the company already has a strong competitive foothold. Building on that, CEO Matthew Prince said its win rates against the competition remained at record high levels during the most recent quarter, illustrating its ability to execute amid a difficult economic environment. In short, investors have good reason to be bullish on Cloudflare. Shares currently trade for 20.7 times sales, not a cheap valuation by any means, but it's still a bargain compared to the 3-year average of 41.6 times sales. At that price, it's worth buying a small position in this growth stock today. Okay, I'm getting hella tired, so today I've read enough of articles related to Shopify. Okay, and this is it. And happy good night. Okay, bye bye.